Okay, folks. A very quick reminder, though I've been emailing you about this. Your first quiz is on March 3rd, which is 2 weeks from 2 days ago. So it's Monday, 2 weeks from now. So I put out the review session, the past quizzes, and the best way to prepare for it is to actually work through the past quizzes. Work through, not look at the problem, look at the solution, because it'll look obvious once you look at the solution. Try to work through, try to get stuck and unstuck on your own before you look at the solution. Okay? And the first few quizzes will take you time, but as you get through, it'll help you in two things. One, it'll get your mechanics nailed down, and the second is you'll get used to the way I write problems. So you're not looking at the new quiz and saying, this looks strange to me. I've never seen anything like this before. Yeah. So that out of the way, I won't ask you about the project because by now you know what the question is, and by now you're not even answering. So I'll assume that you have a company, you picked a group, and you're all on your way. Okay? So today I want to complete our discussion of equity risk premiums. Right? So if you think about where we were in the last session, we started by looking at the equity risk premium for the US, not because we're US-centric, but because this is where the data is richest. We looked at historical risk premiums. Derek, remind me again what the problem with historical risk premiums is? When you look backwards, you get a risk premium for the US. One is it's too noisy. Even with 100 years of data, you get this big standard error. Second, it's by definition backward looking and the world has changed. And three, it's lazy. You're just looking backwards and saying that's what the world is going to look like in the future. And I suggest an alternative, which is a forward-looking premium. Again, don't let the words implied and the mechanics drive you off. It's just like a yield to maturity for stocks. That's basically what we're doing, replacing coupons with dividends and buybacks. And then asking question, what internal rate of return would make my... So it's completely model agnostic. It just says, this is what you're paying for stocks. This is what the expected return is. You back out the premium. And then towards the end of the class, we talked about what do we do with the rest of the world? Whether we like it or not, we have to be aware. And we'll talk about why, even if you picked a US company or a European company, you need to know what the equity risk premium for China is. You cannot value a company without that coming into play. And I started in that process, and I gave you two ways. One was to take the default spread we came up with for a country. Remember the default spread we used for the risk-free rate? And use that as the additional country risk premium, just add it on to US premium. And then as a second and slightly more sophisticated, if you can call it that, you take the default spread and say, that's what I would charge for buying a bond, but equities are riskier. How much riskier? I looked up two numbers, the standard deviation in the equity index. In Brazil, the Bovespa, in India, the Sensex, in China, the Shenzhen, and compare it to the standard deviation of the government bond, like an algebra problem, and say, if I'm charging a 2% default spread for buying the bond and equities are 1.5 times more risky, I'm going to charge a 3% country risk premium. And you add that on to the US premium, you get... So essentially, the US premium is no longer a US premium. It's a mature market premium. It becomes your base from which you build off. At the start of every year, starting, I think, 1994, 95, I've been estimating these country risk premiums. And I didn't do it for others. I need it for myself. And you're going to see this very quickly when we start to value companies. And very quickly, using this approach, I ran into a problem. The problem was to get a standard deviation in a government bond, I need a government bond. And if you remember, when we talked about government bonds to get currencies, there are only about 30 or 40 governments that issue government bonds. And most of those government bonds are not traded. So after about 5 years of flailing, I basically decided to use kind of a shortcut. So at the start of 2025, I'll take you through the process. You can see how my shortcut plays out. To start the process, I estimated an implied, so this is January 1st, 2025. I want to get equity risk premiums for the rest of the world. I started by getting an implied equity risk premium for the S&P 500. I showed you the picture of doing this. I took the index, I took the cash flows, 4.33%. What does that tell me? To the extent that I trust that number, equity investors in the US are collectively demanding a 4.33% premium over and above the T-Bond rate to invest in stocks. First up, I start to take a look at a list of countries. And if a country is mature, I give it the same equity risk premium as the US. And already you can say your question is going to be, how do you decide what's mature and what? I don't want to make that judgment. The backlash I would get by putting some country in the immature column, I couldn't handle. So I take a shortcut. My shortcut is if Moody's and S&P give you a AAA rating, simplistic, I'm going to assume you're a mature market and I'm going to give you the same equity risk premium as the US. You see the logic for this though? Why should all mature markets have roughly the same equity risk premium? Ravi? I'll play it out. What will happen if the US is a mature market and Germany is a mature market? The premium in the US was 4.33% and the premium in Germany was 6%. What will investors do? They will arbitrage suggests you could risklessly lock in you just move your money where you get a higher return. So essentially, when you have mature markets, you can't be having wildly divergent equity risk premiums. So all AAA rated countries, you will see 4.33%. If you're not AAA rated, then my work is cut out for me. Double A, single A, whatever it is. I look up your rating. I come up with a default spread based on the rating. And remember, there are three ways you can use the sovereign CDS market, the same approaches we use to clean up the risk-free rate. I come up with a default spread. And here's where I cheat. Once I get the default spread for your country, I essentially look up two standard deviations. Rather than stay within each country, I look at standard deviations in two indices. One is an index of emerging market equities that S&P maintains. So if you go to the Excel spreadsheet that contains these risk premiums, you can click and it'll take you to that index. It's been around a long time. It's an index of emerging market equities. I look up that standard deviation. And about 10 years ago, maybe 8 years ago, I found an ETF that invests only in emerging market government bonds. It's publicly traded, there's a standard deviation, that number. I take the ratio of the standard deviation of emerging market equities to emerging market government bonds. That ratio at the start of 2025 was 1.35. I apply it to every country's default spread. It's cheating because I'm not doing it in each country, but I can now do it across the board for every rated country. So if your default spread is 2%, let's play it out. 2% times 1.35 is 2.7%. I add the 2.7% to the 4.33%, I come up with an equity risk premium of 7.03%. There are 145 rated countries. I now have a pathway to get the equity risk premium for each of those 145 countries. You think, what if a country is not rated? We'll come to that. But I have the bulk of the world covered now in terms of equity risk premiums. So let's cut past the abstractions. Let's see what the world looks like in terms of equity risk premiums at the start of 2025. Let's pick Latin America. I mean, all too often we think of Latin America as a region, but it's a wildly diverse region in terms of equity risk premiums. The safest country in Latin America is Chile. You can see in terms of risk premium, A2 rating, 1.13%. Country risk premium. So basically, I looked up the default spread for an A2 rating, multiplied by 1.35. I come up with 1.13%. I get a total risk premium of 5.46%. I do this for every Latin American country. The riskiest country in Latin America, no surprise, is Venezuela. The equity risk premium in Venezuela is 27.5%. Think about the equation, risk-free rate plus beta times risk premium. If you have an equity risk premium of 27.5%. What's your cost of equity going to look like for an average risk stock? Even in dollar terms, 30%, 35%. Welcome to risky countries. Your equity risk premium is going to shoot. It doesn't mean you won't invest in Venezuela, but you will have to make much higher returns to break even. So as you look across Latin America, you see the variation. I also compute an equity risk premium for Latin America as a region by taking a weighted average of the equity risk premiums of each of the countries. You're saying weighted by what? By their GDP. Brazil should matter more than Honduras when you think about Latin America as a region because it's half the population of Latin America right there. So when you look at that weighted average, it reflects what I think the equity risk premium of the region is. So as you go through, I've pretty much, as I said, covered the world. This is the most downloaded data set on my website by far. It gets downloaded and used in the strangest places. I've lost all control of how it's used. I just let it ride. I mean, I can track who's coming on my webpage to download stuff, sometimes geographically. And the usual culprits are the English-speaking countries. US, Australia, India always pops up there. But one month I check and Lithuania is on top of the list. My first question is, how many people are there in Lithuania? Why are they all coming to my webpage? It turned out that that month, the Lithuanian privatization authorities had required people to use my equity risk premiums to value their privatizations. I had nothing to do with it. But once in a while, I will get an email from somebody using the data, and I'm not sure how to respond. I get an email from the New Zealand Milk Board. I didn't even know there was a milk board in New Zealand until I get this email saying, we're using your equity risk premiums to set milk prices for farmers. Who are you selling the milk to, Zimbabwe? But usually the question is, how do you come up with it? It's not rocket science. I say, look, I'm not doing deep country analysis. This is how I come up with the number. But once in a while, an email will go over the top, and I just let it ride. I remember getting an email from a Libyan business person, 10 years ago. This is how the email begins. You have destroyed Lebanon. I'm sorry, Lebanese business person. You've destroyed Lebanon. I said, what? I destroyed Lebanon? You've had 30 years of civil war in Hezbollah, and I'm the guy who did it? Eh? What exactly did I do? And it turned out that this Lebanese business person was valuing his business for a sale and hired an appraiser. And the appraiser had used the equity risk premium for Lebanon from my webpage. And I mean, if you look at Lebanon, it's like 27.9. It wasn't that bad. It was like 15 or 15%. And when you use a 15% equity risk premium and you put it into your cost of equity and the cost of capital, you get a high discount rate and a low value. This guy felt he'd been gypped and it was all my fault. I understood, as I said, I wasn't sure how to respond. So I told him what the truth was. I said, it wasn't me. It was Moody's, because ultimately, if you look at what's driving those equity risk premiums, it's not my assessing the country. It starts with a bad rating. You're going to go with that bad rating to end up with a high equity risk premium. So if you're from a country that I've assigned a high equity risk, my deepest apologies to you, but it's really not my fault. It's Moody's fault. So if you don't like the big equity risk premium for Jamaica, take it up with Moody's and maybe tell them that you deserve a higher rating. It's entirely rating driven. One final point, if you look at the top right-hand corner, you see that black box. Take a look at the countries in that black box. You got Algeria, Brunei, Gambia, Guinea, so North Korea, you got Syria. These are called frontier markets. What are frontier markets? These are countries which don't have a rating. Why do they not have a rating? Let's play it out. Let's suppose you get hired by S&P or Moody's. Your first day at work, you're told, we've given you a country to assess. You're very excited. First day at work. So where am I going? North Korea. My guess is you won't stay very long at that job, because you go to North Korea, you might not come back. So there's a reason these countries are not rated. They're in parts of the world where basically people have given up. For the longest time, they weren't on my list. Until I get an email from a Syrian business person. Must have been the last business person left in Syria. Okay. He said, I'm trying to estimate a hurdle rate for my company, and I cannot find an equity risk premium for Syria. Why? Very accusatory tone. I said, you don't have a rating. I can't give you an equity risk premium. He said, what am I supposed to do? I was going to tell him what I honestly thought he should do is maybe get the heck out of there and email me from somewhere else. But I said, you have a point, and I'm going to try to estimate an equity risk premium for Syria. So I started estimating equity risk premiums for frontier markets by effectively adopting another version of cheating. There's no rating for Syria or North Korea, but there are these services that measure country risk with scores. Economist does it. I use a service called Political Risk Service. I've used it a long time. They're all pretty much the same thing. The World Bank does it. They attach a country risk score where they bring in all the things that they think about in that country that should go into risk. Political Risk Services has risk scores for each of these countries. So let's take a country. Let's take Syria's. Risk score is 46.5. The lower the score, the riskier the country. Highest risk score country, the safest country, I think, was Switzerland. but Syria was 46.5. I went looking for other countries that PRS rates, which had scores between 45 and 50, and I found 5 countries. And you can see where I'm going to go next, right? 3 of them had ratings and an equity risk premium. I took those numbers and averaged them out, and I attached to Syria. Simplistic, guilty as charged. But if you can find a better way to assess equity risk premium for North Korea, I'd love to hear it. But at least for the moment, I have a placeholder. So if you're a company that gets half your revenues in Syria and half in North Korea, God help you as a company, but I can give you an equity risk premium. It's going to be huge. You're going to complain about it. But why would you expect something different when you're operating in the riskiest parts of the world? So I update this twice every year. Once at the start of the year, once I will update it again July 1st. Can things happen in the interim? Absolutely. Now, I remember doing this, I think, a few years ago. Sri Lanka had this really decent rating, really, an equity risk premium that reflected. And within the next 6-month period, there'd been a coup. The president had fled the country, and the equity risk premium shot through the roof. So there will be times when these equity risk premiums get dated. Hopefully, none of you is analyzing a company in a country where that'll happen before May 5th. If it does, we'll talk about how to update it. But these are the equity risk premiums of the world. As I said, I need this when I look at companies. And to see why, when you look at a company, the place you often think about is the place of incorporation. Think of Brazilian companies, Indian companies, US companies. And that might have been okay. 40 years ago, the place you were incorporated often was the country in which you operated as well. But if you look at today's world, the way I describe it, we're surrounded by multinationals that through the accident of history happen to be incorporated and traded in some part of the world. My son works at Disney. The headquarters are in Burbank. It's a US company. But in 2013, when I looked at Disney, they broke their revenues down by region. Now do you see why I computed the weighted average by region? Because many companies don't break it down by country. There are too many countries. Coca-Cola, there'll be 72 countries. They break it down by region. So there are 4 regions. They give you the percentage of revenues. You're saying, why did you use revenues? It's the only thing they broke down by region. Beggars can't be choosers. Now, I'd rather use operating income. You might want to use something else, but this is the one thing that companies routinely break down. So there's the breakdown of revenues. That has actually shifted even more away from the US since 2000. But in 2013, 82% of Disney's revenues came from the US, about 12% from Europe, about 6% from Asia, and less than 1% from Latin America. Today, the Asia portion is about 3 times higher than it was in 2013. But in 2013, that's what the revenues look like. There are the equity risk premiums by region in 2013. So don't look at the 2024 numbers, the 2013 numbers. The equity risk premium I would use for Disney as a company is 5.76%. This is going to come into play because when we get into the project analysis section, we're going to look at a Disney theme park in Rio. This is a hypothetical theme park. And I'm going to ask you what the hurdle rate for the theme park should be, and guess what you're going to look at? You're not going to look at the equity risk premium for Disney as a company, you're going to look at the equity risk premium of the part of the world that that project opens up in. So that's the reason you need the entire world in front of you, because if you're looking at, as a global company, at where to build your next factory, where you're directing your next revenue, this will affect whether you make that judgment in the first place. And if you look at the rest of my companies, here's what they look like. Bookscape was easy. Privately owned bookstore in New York City, 100% of the revenues in the US. I just used the US equity risk premium. Vale is a Brazilian company in terms of incorporation, but take a look at the part of the world where they get the most revenues. It's China. Okay? Vale is a multinational, so when I look at the equity risk premium for Vale, it should reflect where they get the revenues. Tata Motors, again, Indian company in terms of incorporation, but China was very close to India at the time that I did this in 2013. Now China is actually a bigger market for Tata Motors than India is, mostly because of the Jaguar Land Rover exposure in China. Baidu, 100% in China. I've never talked to somebody who's used the Baidu search engine who's not lived in China. So maybe one day it'll be elsewhere, but for the moment, 100% in China. And finally, Deutsche Bank. It's Germany, not so basically you can see the spread. Again, the point I'm trying to make is don't look at where a company is incorporated, look at where it does business. Tata Consulting Services might be an Indian company, but when I compute the equity risk premium for Tata Consulting Services, it gets 8% of its revenues in India, it gets 92% in the rest of the world. Now, part of the pushback might be why revenues? As I said, part of the reason for that is the information on breakdown geographically is often just on revenues. But what if your company gives EBITDA by region or operating income by region? Can you use them instead? I tend not to, and I'll tell you why. When you see operating income by region, somebody's estimating the operating income, usually an accountant, right? How do you decide what the operating income is? You take the revenues by region, which you know, and then you take expenses by region. But if you're a big company, you also have these big expenses that are corporate. They get allocated across the region. Somebody's making that allocation judgment. So when you look at things like operating income, I'm a little suspicious about whether I'm getting operating exposure or where your taxes are lowest. Okay? Maybe that's what's causing the allocation. So the reason I stay with revenues is it's always there. It's less subject to accounting manipulation, and it can never be negative. And that's a big deal, right? Because if you have a negative number in the mix, the weights basically get thrown off. I don't know why that page is in there. So the implied equity risk premium that drives these numbers is a 4.33%. So when I talked about implied equity risk premiums last session, I showed you the implied equity risk premium at the start of 2025. Okay. Can you use it all the way through this project? For the moment, yes, because implied equity risk premiums haven't changed that much. But if there is a crisis, you're going to see the implied equity risk premium go into motion. My definition of a crisis, the price of risk changes pretty dramatically over a short period. This is the 2008 crisis. Okay, September 12th of 2008. It's a Friday. I remember I left work early. Why? Because I always leave work early. So Friday, I don't even know why I come into work in the first place. I no longer do, actually. But those days I'd come into work and I left work early, and on the train, and I'm reading the news, and there's a news story that Lehman's is in trouble, but that it's negotiating with Barclays to be bought out over the weekend. I'll be quite honest, the news story, right? This is an interesting news story. It's a big news story for New York, but this isn't going to move markets. And of course, you wake up on Monday and you have the start of that financial crisis. You'd have meltdown. Day by day, through that crisis, I estimated the implied equity risk premium. And that's the advantage of an implied premium, is you can do it on a daily basis. The index moves, you do it. You can do it within the day. Okay? And if you look at what happened to the implied equity risk premium, it started at about 4, so read the green line is implied premium, started about 4.5% on September 12th. There was a day in November where that implied premium was almost 8%. How did that play out? There was a market collapse. When implied premiums go up quickly, the price of the index has to collapse because earnings and cash flows can't keep up. That 8%, by the end of the year, it settled into 6.43%. So can implied premiums change over a short period? They can if there's a crisis and the price of risk changes dramatically. That premium did not get back to pre-2008 levels for almost 6 years. Because there's trauma. After a crisis, you get a more risk-averse premium stay. In contrast, here's here's 2020. There's February 14th of 2020. That's the first news story we get about COVID kind of breaking out of cruise ships in China. And we're saying this is a global pandemic. Between February 14th and March 20th, the implied equity risk premium went from about 4.5% to again about 8%. That was the February 14th through March 23rd was when the S&P 500 lost 35% of its value. Global meltdown. Why? Because people were scared. It wasn't just the economy shutting down. Nobody had any idea what was coming. And many of you remember, right? I mean, you might have not been in business or markets, but remember those months where you had no idea whether the shutdown, how long it would last, will it open up, when it opens up, what will happen. In hindsight, we claim to know, but at that time we did not. What was different about 2020 is how quickly the market changed its mind. On March 23rd, 2020, it was the end game. People were convinced that this meltdown would not, basically that stocks would never come back. And experts said this is going to be trauma. We're going to take years to, but by September, the market was back to where it was before the crisis. So one of the advantages of implied premiums is everything can change quickly and you can track it, and you're doing country risk premiums because it becomes the base number. You're basically going to see equity risk premiums rise very quickly across the board for all countries because that base number has gone up. So let's talk about the start of 2025, what the world looks like in terms of implied premiums. So I showed you the November 2013 number. You see what happens in a crisis. Start of 2025, the S&P 500 was at 5,881.53. Okay. Got my expected cash flows for the next 5 years using exactly the same process I used in November of 2013. Get the trailing 12-month data, and then project out based on analyst growth rates what those cash flows will be in year 1, year 2, year 3, year 4, year 5. Beyond year 5, cash flows continue to grow, now at a risk-free rate of 4.58%, because that's what the risk-free rate had become. Exactly the same process. I solve for an expected return. And at the start of 2025, based on what people were paying for US stocks, the expected return on stocks was 8.91%. You subtract out the risk-free rate of 4.58%. The implied premium you come up with is 4.33%. That was the base number that you saw when I computed all of the country risk premiums. So as you go through 2025, you're going to see that number kind of shift. And here again, there's a divergence between what markets are saying and what macro economists are saying, right? Because macroeconomists are saying we're in terrifying times, change is coming, tariffs and taxes and crazy things are happening. But markets, at least for the moment, seem to diverge from experts. And I'm going to hold my judgment. Because every time experts and markets have disagreed in the last 4 years, I've looked back and said, I wish I trusted markets. Right? Because it turns out that at least in the aggregate, markets seem to get it more correct than experts do. So at the moment, that's what you're looking at. In fact, if you look at the 5881, do you know what that number looks like today? You know, what's the S&P 500 at? It hit a new high yesterday, I think, 6,100 maybe. So the index has gone up. I'm going to ask a pure math question. Assuming the cash flows haven't changed dramatically, if the index goes up, what should happen to your expected return? Go down or go up? You pay more up front. Think bonds and interest rates, right? You pay more for a bond. What do you do to the interest rate you earn on the bond? It goes down. Same phenomenon kicks in. Index goes up, the expected return comes down. The T-bond rate is now down to about 4.47% from 4.58%. Slightly lower T-bond rate. The index has gone up, so slightly lower expected return. The equity risk premium has pretty much stayed around 4.3%. But as I said, could change in a dot. September 12th of 2008, everything looked fine until 2 days later you woke up and said, it's not that fine. So this can change dramatically. Now, I'm not wishing a crisis on you, but if a crisis does come, you have a mechanism for saying, I'm going to adjust my cost of equity and cost of capital because what I estimated a week ago is no longer appropriate. One final graph before we leave these implied equity risk premiums discussions behind us. I've been graphing this implied equity risk premium going back to 1960. Obviously, I didn't start doing it in 1960. I'd have been too young to start implied premiums then. But I've put so the way I estimate the implied premium in 1960 is I assume I know nothing about what happens after 1960. I put myself down January 1st, 1960, based on what I knew, and I compute the implied equity risk premium start of every year. And you can see the graph tells you the history of US equities for the last 60 years. In the 1960s, implied equity risk premiums in the US were between 3 and 3.5%, and they were very stable. The US was the center of the global economic universe. It was the most mean reverting predictable market of all time. And by 1970, people said, what can happen in the US? We're a mature market. We are the global market. And then you get to the 1970s, clearly something is changing. The implied premium is rising. So remind me again, premiums go up. What's happening to stock price in the 70s? They're going down. Right? What was triggering the increase in premiums in the 1970s? Oil shock triggered it, but that was a global phenomenon. But in the US, oil shocks translated into higher inflation. You're saying, won't oil shocks always translate into higher inflation? Not necessarily. If you accept lower economic growth, all it changes relative prices, but here it translates into higher inflation. For the first time, the US actually faced double-digit inflation. And that is terrifying for investors. It adds to the uncertainty. Implied premiums reflected that. In 1978, the implied equity risk in the US hit 6.5%, the highest number until then, because afterwards in 2008, in 2020, we broke it, 6.5%. You know what the Dow was at in 2008? It had 3 digits in it. It was about 800. The Dow was at 800. Now it's at what, 42,000, whatever it is, 800. The absolute low for the market. People were convinced that stocks were never coming back. It was the end. You're loading up on real estate and gold, saying that's the place to be. And then it went to the great bull markets of all time, 1978 through 99. By the end of 1999, the implied equity risk premium in the US, the peak of the dot-com boom, the implied equity risk premium for the US was down to 2%. Remember that survey I did last Wednesday? Where I asked how many of you would buy stocks if I offered you a 0 to 2% premium? I don't think anybody did. I think 2 to 4 somebody accepted, 0 to 2 no. Did anybody? I don't remember. Did anybody put up their hand for the 0 to 2? So essentially, what were you saying? 2% is too low. I'm not investing in stocks. 1999, that's what the entire market was delivering. You know what the definition of a bubble is? Is when you price things to earn 2%. But then when I ask you, how much do you think you can make on stocks? You say, I think I can make 6% more than the risk-free rate. One of those things has to be false. And guess what? The world doesn't bend to your expectations. You have to adjust to a reality, and that's what happened after 1999. There's a bubble bursting. The equity risk premium goes back to 4%. Stays around 4% for about 4 years. Then you have the 2008 crisis. There's a spike. And since 2008, equity risk premiums in the US and around the world have become higher and more volatile. In fact, in 2024, for the first time, we saw equity risk premiums drop back to pre-2008 levels. So for 16 years, equity risk premiums stayed higher. And I don't think that's a passing phenomenon. I think it reflects a reality of globalization, which is everybody's connected to everybody else. There's no such thing as a local crisis anymore. It spills over. And you're seeing that show up in the equity risk premiums. Those 2 pages, I don't know why they repeat. So here's what I'd like you to do. Right? I'd like you to take your company and break down the geographical, in terms of geography, where the revenues come from. Right? So take and look, some of you will be frustrated when you look at that breakdown, because it might not be as good as you'd like it to be, because some companies are not very good about their geographical areas. They might lump things together. European companies, for instance, break their revenues down based into what's called EMEA. Europe, Middle East, and Africa is one grouping. Terrible way to bunch revenues together, because those are very different in terms of country risk. Now, don't rage against the machine yet. There's no point. Take what you can and a computer weighted average and move on, because that's what the information is giving you. So take your breakdown, see if you can come up with this all presupposes that you've already picked a company. So if you picked a company, try to come up with an equity risk premium. It's a starting point for thinking about country risk and how it plays out in your cost of capital. So let's now talk about betas. We've talked about risk-free rates, and the risk-free rate, we said, depends on the currency you decide to do the analysis. And we've talked about equity risk premiums, and that reflects where you do business. Okay? Let's talk about betas. In foundations, you've probably seen the standard way in which we're all taught to estimate betas. The way I was taught, the way you were probably taught, is to run a regression of returns in the stock against returns in a market index. And it told the slope of the line is the beta. So basically, when you look at this regression, the slope measures the beta of a company. And statistically, here's why betas measure risk. Beta is the measure of risk you cannot diversify away, risk coming from the market. So by running this regression, you're saying how much of the risk in my company comes from the market. It's a terrible way to think about beta, so because it makes it into a statistical number. You run a regression, the slope of the line is the beta. Incidentally, in that regression, there are two other pieces of output that I'm also going to track. The first is the intercept, right? When you run a regression, there's an intercept. I'm going to argue that the intercept of this regression is telling you something about how well or badly your stock has performed during the period of the regression. It's a measure of stock performance. So you run this regression for NVIDIA, the intercept is going to be hugely positive because you've had 2 years or 5 years of incredibly good returns. So the intercept is going to measure performance. And there's also another piece of output you get from any regression you run called the R squared. Statistically, we know what the R squared measures. It measures the proportion of variance in your dependent variable that is explained by your independent variable. But step back and think about your dependent and your independent variable here. Your dependent variable is a market, when you think about what you put is your market index, whatever the index you pick. Your independent variable is the stock. So the R squared tells you how much of the variance in the stocks is explained by the market. If that sounds even remotely familiar, when we talked about risk you can diversify away and risk you cannot, the R squared tells you what proportion of the risk in your stock you cannot diversify away. So the slope of the line tells you about risk. The intercept tells you something about performance. The R squared tells you something about where the risk in your company is coming from. So let's start with the intercept before we go into the beta. Okay. That is the original CAPM, that the return on a stock is the risk-free rate plus beta times RM minus RF. That's a standard equation for the CAPM. I'm just going to do a little moving around of terms, and I can restate the CAPM as risk-free rate times 1 minus beta plus beta times RM. So if you take the CAPM, the traditional CAPM, the expected return on a stock can be written as the risk-free rate times 1 minus beta plus beta times RM. The regression we've run is returns in the stock against returns in the market index. So compare those two equations. The slope, obviously, is the beta. And the intercept, if your stock did exactly as the CAPM predicted, should be equal to the risk-free rate times 1 minus beta. So when I run the regression, I'm going to look at the intercept. I'm going to compare to the risk-free rate times 1 minus beta. If they're roughly the same, I'm going to say your stock did roughly as well as I thought it would, given the model. If your intercept is much greater than the risk-free rate times 1 minus beta, you're a winner stock. You did much better than expected. And if your risk-free rate, if your intercept is less than the risk-free rate times 1 minus beta, your stock did much worse than expected. And I do this for every stock that I want to ask a question about. So you can, that difference between the intercept and the risk-free rate times 1 minus beta is called Jensen's alpha. And now there's a story behind it, which I think is worth saying. It's named after Michael Jensen, who in the 1960s at the University of Chicago essentially worked on finance when it was a very young discipline. So in the late 60s, Michael decided to ask a question which people took for granted they knew the answer to, which is, do professional money managers do better than the market? So in 1968, Michael Jensen decided to take 125 mutual funds. That's how many funds there were. There were so few funds that he could just take the entire sample. And he did this Jensen's alpha on every one of the funds. So remind me again, if professional money managers do better than the market, what should the intercept look like when you look at their returns? It should be higher than the risk-free rate times 1 minus beta. In other words, Jensen's alpha should be positive. And he thought that's what he was going to find. And he came back with what has become one of the most enduring results in finance. He discovered that out of the 125 funds, 90 actually had negative Jensen's alphas. And collectively, the mutual funds delivered a return, Jensen's alpha, that was negative. Essentially, their active investing was delivering a negative return. And that's a result that's been replicated pretty much every single time people have looked at it. That's a topic for a different, we could ask, why does active investing continue to exist if it's collectively this exercise in futurity? But that's where the Jensen's alpha was born. So we're looking at actual returns versus the expected return. So you're going to run the regression, you take the intercept, you compare it to RF times 1 minus beta, you've essentially got to measure whether your stock, and it's purely a post-mortem. It's not telling you what's going to happen in the future. So when you do this, as I said, for NVIDIA, what you're going to find out is NVIDIA was a great investment over the last 2 years. But don't jump to the next conclusion and say if it was a great investment the last 2 years, it will be a great investment for the next two. Because that part is very murky. You can't make predictions for the future, but it does give you a postmortem. So that's the first stop. But to do all of this, though, first you've got to run a regression, right? And the regression, at least in every textbook, says returns on the stock against returns on the market index. So let's talk a little bit about the choices you will have to make to run this regression. First, you have to decide an estimation period. Well, let's take a stock like Disney. It's been publicly traded for 70 years. I can go back all 70 if I wanted to. The data is there. I can go back 10 years. I can go back 5. At first, your first reaction might be, I want more data. 70 is better than 10. I'm going to go back 70 years. But there's a catch here. If you go back 70 years, you get a very different company than the company that exists today. Disney in 1954 produced one animated movie a year. There was no Disneyland, there were no theme parks. It was a small movie company that made animated movies. Disney today is an entertainment colossus. So the danger of going back too far is you're going to get a very different company. Think, should I just go to 6 months then? Well, that's the other end. If you go too short a period, you won't have enough data. Most services that estimate betas use between 2 and 5 years. I gave you the little suggestion on how to pull up the beta for your company in Bloomberg. Bloomberg's default is 2 years. Okay. Value Line used to use 5 years. S&P, I think, uses 5 years. So basically, it's 2 to 5 years, and you can see why people end up in that sweet spot. Saying, what if my company's been listed only a year? You take only whatever you have available. If that's all you have, you run the regression over that period. So that's the first stop, how far back to go. Second, once you decide to go back 2 or 5 years, you have to decide how to slice up the data. What am I talking about? Let's say you take 5 years of returns. You can look at 5 years of monthly returns, which would be 60 observations. 5 years of weekly returns would be 260 observations, or 5 years of daily returns, which would be 1,250. Again, if you're driven by the numbers, the choice seems obvious. Let's go with daily returns. It'll give us more data. But daily returns are noisier because if you don't get trading towards the end of every day, the returns won't match up. It's in fact, the daily return betas tend to all converge around 1. You don't get much divergence because of the noise. So most services use either weekly or monthly returns. Talked about Bloomberg. Bloomberg uses 2 years of weekly returns, 104 observations. So every company, when you look at that beta page, you start off, the default beta page will be 2 years of weekly returns. Third stop, you got to estimate returns each period. That should be easy, right? Change in price divided by the price at the start of the period. In most months and most weeks, that's all you'll be looking at. What's the change in price? You divide by the price. Don't divide by average price. Divide by the price at the start of the period. You're going to get return for that week or month. With one catch, which is in a few of the periods, you will get a dividend. In the US, it's usually once every 3 months, a quarterly dividend. In Europe, it could be once every 6 months or even once a year. Don't try to be fair and spread it out across the weeks. If you're holding the stock in the week in which it goes ex-dividend, you and only you will get the dividend. That seems like an easy moneymaker, right? Why don't we just buy stocks in the week or the day of the dividend, just collect the dividend? What's the catch with that? Yeah. It's not that it gets subtracted, but the price will drop by roughly the amount of the dividend. So if you try this to make money, you will get the dividend. So that's a win. But in the day that the stock goes ex-dividend, the stock price will drop by roughly the amount of the dividend. So, that's why you don't get a whole lot of trading just before a dividend, try to collect it, because you're not going to make any money. It's just going to replace a price appreciation with the dividend. But when you're doing returns in that week or that month, you've got to put the dividend in precisely to offset the price effect. Because if you don't put it in, you're going to every 3 months see a negative return on a big dividend-paying stock because you get the price drop that month. So you compute. So you picked a period, you picked an interval, you computed the returns for your stock. There's a final choice to make. You have to pick a market index, right? You know how many market indices there are just in the US? Let's start with the most commonly talked about. When people talk about the market still, when you hear about it, which is the index that people tend to still focus on? I'd love to say it's the S&P 500. Still the Dow 30. Why? Because the index that's been around the longest, it goes back almost 150 years. It's a terrible index because the 30 companies are not, there's no rhyme or reason for why they're there. I mean, they're big companies, but they're not the 30 biggest companies. But there's the Dow 30. Then there's the S&P 500. Somebody tell me how S&P decides which 500 companies to include in there. What's a driving criterion for whether you're in the index or not? It's market cap. It's a market cap driven index. There are a few other criteria which you have multiple classes. If there's not enough liquidity, they might cut you out. But it's really the 500 largest market cap companies. It's a market cap weighted index of the 500 largest market cap companies. The S&P 500 has only 500 companies, but those 500 companies account for 85% of the market cap of all US companies. File that away. So you got the S&P 500, you got the Dow 30. You have the NYSE composite, which is all of the listed stocks in the New York Stock Exchange. But increasingly, it's getting disconnected from the market. Why? Take a look at the 7 biggest companies in the market, right? They're all in the NASDAQ. They've stayed. In the old days, it used to be that when you got to be a bigger company, you transition from the NASDAQ to the NYSE. That's no longer the case. So, you have the NYSE composite. And then you have the NASDAQ index, which is really a tech index. You can't call it a market index. And there are indices like the Wilshire 5000, which includes 5,000 companies. And you have all these choices. On the Bloomberg, there's a default index, but you can change the index to any one of those other indices. Or you can even pick a sector index. There are tech company indices and pharmaceutical company indices. So before we make that choice, I want you to think about what should go into picking the best index to get a beta for. All of this is in service of what model? The capital asset pricing model, right? Do you remember what we all ended up holding in a CAPM world? We all ended up holding the market portfolio because we had no trading costs and no information costs and no way of telling which stocks were cheap. What was in that market portfolio? Every single traded asset in the world held in proportion to its market value. So we can start already knocking off indices. Can I run a regression against the Dow 30? I can, but it'd be pointless. It's a terrible index. Why there are only 30 companies? Even the S&P 500 is only 500 companies, but its saving grace is their market cap weighted, and it's 85% of the index. So if you had to pick an index, S&P 500 wins out over the Dow 30, it wins out of the NYSE composite, it wins out over the NASDAQ. An index like the Wilshire 5000 might look like a better index, but it doesn't have, and people don't trust it enough. It doesn't have the kind of history. You can already see why, almost by default, if you look at beta services in the US, the index you will see getting used to get a beta for a company is the S&P 500. But before we leave this though, was there anything in the CAPM that said only domestic stocks in a market index? It's a traded assets, right? Could be global. I want you to hold that thought because if we're estimating betas for companies in a world with global traders, should we even be running these regressions against domestic indices, which is what we traditionally see done? Or should we be looking at something that is a global index and estimating betas against a global index? No service does that right now. But we can talk about maybe that's where we should be moving towards. But for the moment, you see domestic indices. For the US, you'll see the S&P 500. So I want to run a regression of Disney against the S&P 500, and I have to make choices, how far back to go and what interval to use. So in 2013, when I did this, here are the choices I made. I use 5 years. If I want a good beta estimate, my preference is 5 years over 2 years because I prefer to use monthly data. Monthly data is better than weekly. Weekly is better than daily. And once you go monthly, you can't go with just 2 years because you have only 24 observations. So I'm almost trapped by my choice of return interval to go back longer. So 5 years of monthly returns, and I'm going to stick with what every service is using, the S&P 500. And every month, so initially when I did this on an Excel spreadsheet. Every month I collected the Disney price at the start of the month and Disney price at the end of the month. So if you take December of 2009, the stock went from $30.22 to $32.25. It went up by $2.23 in that month. It was a good month for Disney. And during that month, which happened to be an ex-dividend month, there was also a 35-cent dividend. So to compute the return, I take the change in price, I add the dividend, and I divide by the price at the start of the month. I end up with a return for Disney of 7.88% in December of 2009. And I do this for every month for 60 months. Sounds like it's a lot of work, but in an Excel spreadsheet, just copying that equation down. So now I have, with 60 months of data, 59 months of returns. Do you see why I lose 1 month? To get the return, I need the change in price. So the first month, so I have 59 months of data. Now I turn to the index, and I do exactly the same thing. I take the index at the start of the month, index at the end of the month. I take the change. But with the index, there is a little bit of a problem because the index is composed of 500 companies, some of which pay dividends, some of which don't. So collectively, there's a dividend on the index as well. You don't see that when you track the index, but there is a dividend. And you can see what that dividend is. You go to Bloomberg, they report the dividends per month. In December 2009, that dividend on the index was 1.683. And I do exactly what I did for Disney for the S&P 500. Take the change in price plus the dividend divided by the index at the start of the month. I end up with a return for Disney. In December of 2009, the market was up 1.8%, but Disney was up 7.9%. Why? Something good happened to Disney. Maybe a movie did better than expected. And I did this for every month. And when I was done, I had 59 months of returns for Disney and 59 months of returns for the S&P 500. Now, before we had regression packages, we had to run a regression by hand. The first thing you did was you created what was called a scatter plot. In a scatter plot, here's what you do. You take each month of data and you look at what the return on the stock was and the return on the index, and you plot that. So there should be 59 points if you want to count. Each month has. And then you fit a regression line. That sounds like a weird thing to say. But how do you come up with this best fit line? You remember in statistics how in a regression we fit this line through the points? What's the criterion we use? In fact, the way a regression is described in a statistics kind of gives it away. You minimize the squared distance from the line. The original Greek version of a regression, people actually measured the distance. So there's a lot more work than running it through your Minitab or SPSS or whatever your package is. They took the distance, they squared the distance, say, I want to minimize the squared distance from the line. So trust me on this one, this line that I fit through is the best fit line. If you don't believe me, come up with a ruler, take the distance, square it, see if you can minimize. But that is the criteria. Of course, with regression packages, it does it for you. It finds the best fit line. And if you have a regression package, it vomits out the output from the regression, right? It gives you the intercept, the slope, the R squared, but then it also reports the standard errors on each of those numbers, telling the world, look, there's a number, but this is what you have to watch out for. So let's look at what the output from this regression was. First, the intercept was 0.0071. What does that tell you? For the moment, it's a good news that it's positive. If you're negative, already you're in a hole and you start digging, it's positive. How positive? We have to compare it still to the risk-free rate times 1 minus beta. The slope was 1.25. The 2 extra decimals is kind of overkill. What does that tell me? To the extent that I trust this regression, the beta for the company is 1.25. You're saying, what's this 0.10 below? That's a standard error in the estimate. So I have a regression number 1.25, but I'm saying, look, it's an estimate. I could be wrong. Here's how wrong I can be. And finally, the R squared of the regression was about 73%. 73% of the variance in Disney stock can be explained by the market. Or put differently, 27% of the variance in Disney stock is completely coming from the company. So when you think about diversification, you can't do much about the 73%, but you can take away the 27%. So let's take this regression output and see what we can extract from it about Disney as a company. one of the good things to do at the start of looking at a company is to get acquainted with your company. You know, what kind of company is it? Being a good company, a bad company, how is it done? Running the regression gets you started in the process. So let's start with the intercept. The intercept was 0.71%. So 0.00071 in decimals is 0.71%. So the intercept is 0.71%. I need to compare to the risk-free rate times 1 minus beta. My returns are all monthly returns. So my risk-free rate has to be a monthly risk-free rate. So if you look at the monthly risk-free rate there, between 2008 and 13 was 0.5%. That's an annualized rate. So to make it monthly, I've got to divide by 12, so I've got a risk-free rate of very close to 0, 0.04%. So that's my risk-free rate. Multiplied by my beta gives me a risk-free rate times 1 minus beta of minus 0.01%. So what does that even tell me? If Disney had done exactly as predicted by the CAPM during this period, the intercept I should have come up with should have been minus 0.01%. I actually came up with 0.71%. You take the difference between those two numbers, 0.72%, that's how much Disney did better than expected on a monthly basis. Doesn't sound like much, right? 0.72%, but that's per month. If you annualize that number by raising it to the power 12, the return I come up with is 9.02%. On an annual basis between 2008 and 2013, Disney delivered 9.02% more than expected. We give you a very simple way to get a grasp on what a Jensen's alpha is. Let's assume that you have a stock with a beta 1.5. Let's say the market is up 20%. Let's say the risk-free rate is close to 0. If you have market up 20%, you have beta 1.5. How much should your stock be up? About 30%, right? When you have a Jensen's alpha of 9%, you deliver the 30% plus 9%. So it's over and above the expected return. Jensen's alphas, basically, as I said, are a postmortem. All it's telling is between 2008 and 2013, Disney did really well. It delivered more than expected. And then you can dig deeper. What did it do to do better than expected? Maybe it bought Pixar sometime during the period. It bought Star Wars during that period. Maybe that's what's pushing up the returns. But you look for an underlying source, not just a number. It's telling me something about the company. So let's assume you do this for every single traded stock in the market. Mechanically, it sounds like a lot of work, but it's the same process for every company. Take starting with A, working through Z. You compute the Jensen's alpha for every stock. So you got 2,000 stocks. You got the Jensen's alpha for every stock. What should the average Jensen's alpha be across all stocks? Does it matter whether the stock market was up or down or... Let's say the market was strongly up. Should the Jensen's alpha therefore be a big positive number? Remind me again what Jensen's alpha measures. It measures what your stock did after correcting for what the market did and the risk of the stock, right? Can stocks collectively beat themselves? Obviously not. The average Jensen's alpha across all stocks, really a weighted average Jensen's alpha should be roughly 0. So what I'm preparing you for is when you compute the Jensen's alpha for your stock and you get 0.1%, part of you is going to say, that's not very much. My stock didn't do very well. The fact that you have a plus in front of your Jensen's alpha is already a win. Because half of all stocks will have negative Jensen's alphas. And you've said, thank God, my stock is not one of those. Jensen's alphas you compare to 0 because the average across all stocks is 0. And if you use that, then clearly Disney had a good 5-year period. Jensen's alpha was 9%. So I want one follow-up question. During this period, Bob Iger was Disney's CEO. He came in after Michael Eisner. He's clearly done an incredible job, right? 9.0. Should I therefore give him a big bonus because the Jensen's alpha is positive? Or do I need to stop and check something else before I start rewarding management for having positive Jensen's alphas or firing management because they had negative Jensen's alphas? What's the last stop I have to make? Yeah. It's possible that entertainment companies collectively had a good 5-year period. The best way to think of this is oil companies, right? If you take any 5-year period for oil companies, you either get really big positive Jensen's alphas, really big negative Jensen's alphas. What drives it? What oil prices did. The top management had nothing to do with that. So the one point I would emphasize is if you do find for your company that it a big positive Jensen's alphas, it's not a sign necessarily that the management is doing a great job. They might just have been in the right place at the right time. Conversely, if your company has a big negative Jensen's alpha, before dumping on your management, you might want to step back and say, well, is this something that was sector-wide that they really could not avoid? On my webpage, I have average Jensen's alphas by industry group. And the reason I have that there is when I compute the alpha for a company, I want to compare to the industry and say, am I capturing something that was industry-wide or something that is specific to the company? So any questions about Jensen's alpha? If you're an investor then, what's the essence of successful investing? What are you trying to find? If you think in terms of Jensen's alphas. Your portfolio should be composed of companies that will have not positive Jensen's alphas in the past, but will have positive Jensen's alphas in the future. That's why in investing, you have this thing called alpha that portfolio managers talk about all the time. What's your alpha? Alpha basically is that excess return. It's their version looking forward of, I'm a good stock picker, and if I'm a good stock picker, I should be able to find companies that are more likely to have positive Jensen's alphas than negative. And that's what Michael Jensen discovered did not work in active investing, but maybe you're the special one. You can do this better than those investors can. Now, when you look at NVIDIA's Jensen's alpha, is anybody doing NVIDIA for their project, for the project? Nobody is? Really? I'd have thought a lot of people have gathered around successful company. But you can already see, even without doing the math, what do you think the Jensen's alpha is going to look like for NVIDIA? It's going to be like 150%. And while you look at the 150% and regret not buying NVIDIA 2 years ago, which we tend to do, right? We look at a great stock and say, I wish I'd bought Palantir a year ago. I don't own Palantir. I wish I. The reason I don't want to spend too much time there is for every stock like NVIDIA with a 200% Jensen's alpha, there has to be a stock at the other side, which is like it can't be minus 200% obviously. So as you regret not buying NVIDIA, you should also probably stop and say, thank you God for not letting me buy that stock with a minus 95% Jensen's alpha. Life is too short for regrets here. So when you compute a Jensen's alpha for a stock, it might not tell you much about what you can make as an investor because it's too late. But it's also not worth looking back and saying, I wish I'd bought the stock 2 years ago, because that's not going to get you very far. So Jensen's alphas measure performance. They measure past performance, not necessarily future performance. And across all stocks, the average Jensen's alpha is going to be 0. So all you're looking for is, can you beat 0? Let's talk about the slope of the regression. Slope of the regression here was 1.25, but I did give you a standard error of 0.10. Let's see if you can remember enough statistics to fill in the details here, right? So you got a slope of 1.25, standard error of 0.10. If I ask you for a point estimate, one number, what do we train in statistics to give us that one number? It's going to give the 1.25. And most services stop right there. But if you were in a statistics class and I pushed you and said, that's your point estimate, one number, but can you give me a range with 67% confidence, which is not a great deal of confidence. You're going to be wrong 1/3 of the time. What's the significance of the 67% in terms of statistics? It's one standard deviation on either side. The coefficients from regressions are normally distributed. So if you have a 1.25 beta and a 0.10 standard error, the true beta can be anywhere from 1.15 to 1.35. Everybody clear where if I ask you for 95% confidence, that's 2 standard errors. It's 1.05 to 1. And you can play it out. 99% confidence becomes 3 standard errors. The point I'm trying to make is that regression doesn't tell you what the beta is. It gives you a range on the beta. You're saying is 0.10 a big standard error? By US company standards, it's a small standard error. The median standard error for a beta estimate in the US is closer to 0.25. Next time you see a service beta for a company of 1.1 or 1.5, remember there's a range around it. It's a typical US company. That range can be a pretty wide one. And already you can see why trusting a regression beta as the right beta for your company is already a dangerous place to be. because it comes with this big range around it. Last piece of output from the regression was the R squared, 73%. At regression, if I trust the regression, 73% of the risk in Disney comes from the market, from inflation, interest rates, big macroeconomic forces. 27% is company specific. So how well the Avengers movie does is in the 27%. But whether people come to the theme park because exchange rates change could be in the 73%. And if you trust the CAPM, it's the 73% that you're going to get rewarded for. So you don't even have to trust the CAPM. If you're diversified, it's only the 73% that matters, right? But now, just as an aside, I've been computing these R squareds for US companies for a while. And since 2008, the average R squared for US companies has gone from about 30% to about 50%. So across the board, there's been an increase in R squared. What does it tell you about markets and economies when you see the R squared for an entire market, especially one as big as the US, go from 30% to 50%? And I gave you kind of a clue, 2008. What do you think 2008 brought to the table that's changed markets, I think, effectively forever? Macro risk has become a much. There was a time in the US where you were told, especially old-time value investors, just pick a good company. That's all that matters. You're going to make money in the long term. And in the 20th century US, that was absolutely true because the economy didn't do crazy things. You didn't get major shocks to the economy. You picked a good company, you were effectively rewarded. That's no longer going to be the case because post 2008, you could pick a good company and then Brazil goes to hell in a handbasket and your company goes down 30%. You say, what happened? It is effectively a change. It means that stock picking has become much more difficult because you can no longer just look at the company. You got to think about the macro environment you're in because that's going to affect the return on the investment. You can complain about it as much as you want, and value investors do, but that is the fact. Those are the facts you face on the ground. We're a world in which macro risks matter a lot more than micro than they used to. And that's affecting active investing and how you pick stocks. So you have players like Cathie Wood. Cathie Wood essentially makes macro bets on trends and says, if I get that right, I'm going to make money. And you can see more of that happening as macro risks start to push micro risks to the background. One final point, since we're talking about R squared. No, I'm going to ask you to think like an investor. And I'm going to give you two companies. And I want you to tell me whether the R squared from the regression, let's say I've computed both, is going to affect which company you invest in. So you are a diversified investor. So you could be a mutual fund or you're just an individual investor who's diversified. And I come to you with two companies, Disney and Amgen. Let's say they both have the same beta, 1.25. But Disney's R squared is 73%, but Amgen's R squared is only 25%. Why? Because it's a pharma company. A lot of the risks are drug specific. They have nothing to do with the market. But my question is one of choice. Let's say you can pick only one of these two stocks. They have the same beta, but very different R squareds. So here are the three choices. You'd pick Amgen because it has a lower R squared, Disney because it has a higher R squared, or you wouldn't care. So how many of you would pick Amgen because it has a lower R squared or less of its risk, its market risk? Franz, you look like you might pick it. Okay. And what would your rationale be? But remember, you're diversified. The only risk that you'll feel is the risk that you cannot diversify. And guess what measures that? The beta already measures it, right? So the fact that the R squared is different, R squared just tells you the proportion of the risk that comes from market. Beta actually tells you the units of risk you face, right? So as a diversified investor, you could probably could say, I don't care. Because the portion that's not market is going to get diversified away anyway. So diversified, excuse me, diversified investors should not care what the R squared is. But let's say that the investor is your eccentric uncle. He doesn't trust mutual funds. He buys only 5 stocks. Why? Because that's his magic number 5. And he comes to you and says, should I buy Disney or Amgen? If you have an undiversified investor, which one should you buy? The low R squared stock or the high R squared stock? Anybody have any? Let's play it through. You're undiversified. You buy the low R squared stock. You're buying a risky stock, right? And because you're not diversified, you're going to feel all that company specific risk. If you're undiversified, you should go with the high R squared stock, because if you buy a low R squared stock, you're going to take risk you're not going to get diversified for. So for God's sakes, if you own 5 stocks, don't make it Palantir and basically companies with low R squares where you sit there saying big things are happening to my company. Buy companies that are maybe JP Morgan with R squared of 75%, Disney with an R squared of 73%. That way you do less damage to yourself as an investor by not being diversified. So if you're not diversified, you probably should tilt towards high R squared stock. Most of the risk is market risk. You're less exposed to company specific. If you're diversified, the R squared doesn't matter. The risk is going to get diversified away anyway. Now, until 2001, when I taught this class, one of the requirements for the project was you did what I did for Disney. What does that require? Take 60 months of data, collect stock prices for 60 months, collect the index for 60 months, collect the dividends as well. And in fact, doing it today is, if any of you want to do it by hand, you can get the data. You go to Yahoo Finance, you can get the monthly data on a stock, monthly. It wasn't difficult to do, but was tedious. And then the first Bloomberg terminals arrived at Stern. They used to be down in the basement in the computer room. And it was a godsend, because basically it meant that I didn't have to ask people to run regressions, which were tedious. They could go to Bloomberg, find their company, which took a little doing if it was an obscure company. But once you found it, if you typed in the word beta, you got a page that looked like this. Okay? This is the regression beta page for Bloomberg. And I got the Bloomberg beta page for Disney from 2009 to, remember that regression I ran with an Excel spreadsheet? I wanted to see if I went to Bloomberg, whether I would get the same numbers that I got from running the regression. Same stock, 5 years, monthly data, S&P 500, everything should match up, right? So let's start with looking at the output. First, there's the raw beta. That's a regression beta. I'll talk about the adjusted beta in a moment. But the raw beta for Disney is 1.247. Do you remember what my Excel regression beta was? It's 1.252. I can live with that. Round it up, I'm getting the same answer. So far, so good. The intercept, which they called alpha, was 0.599. Bloomberg is very sloppy about decimals and percentages. At 0.59 is 0.599%. In my regression was 0.71%. And for the longest time, this was the diversion that would drive me crazy, is the intercept on Bloomberg did not match up to the intercept I would get from an Excel regression. And finally, I found out what the reason was. When I ran my regression, how did I get returns every month? I took the price change. And then if there was a dividend, I included that. When I did the index, I took the price change, and then I added the monthly dividend. Bloomberg runs its regressions entirely with price changes. Why? Because it's easier for the computer. You don't have every third month. You don't have to deal with it. And their reaction would be, most people come to this page to get the beta. You're getting roughly the same beta. Why are you complaining about the intercept? Nobody uses it anyway. I do, so I want to run it right. So I do think dividends should be part of the equation. So if you're getting an intercept that's different from running a regression by hand, that's part of the reason. The R squared, 73%. Pretty much where I was. Its third decimal was off. So the beta and the R squared are pretty close. And will that always be the case? If you have a non-dividend or a low dividend paying stock, it'll probably be very similar to Disney, beta and ours. But if you have a big dividend-paying company, you're doing a beta for a real estate investment trust or maybe a bank which pays a big dividend, your Bloomberg beta is already off because a big chunk of your returns come from dividends, and the regression is being run without those dividends. So by all means, use the Bloomberg beta page. But remember, if you have a big dividend-paying company, that beta might be skewed. And if you really want to see what the beta looks like, you really have to go to Yahoo Finance, download the prices, and run it for yourself. One final point, you're saying, what's the adjusted beta? Sounds fancy, right? Adjusted. Now, the old days, they actually used to tell you what the adjusted beta was. I'm going to give you how Bloomberg computes adjusted beta, not just for Disney, but for every stock that they track. So when you put up the beta for your company, Here's how the adjusted beta is going to be computed. And if you don't believe me, test it out. It's 0.67 times the raw beta plus 0.33 times 1. You're saying, what? If your regression beta is 1.8, your adjusted beta will become 1.53. If your regression beta is 1.5, your adjusted beta will become 1.33. If your regression beta is 1.2, it'll become 1.13. And if your regression beta is zero point 0.6, your adjusted beta will become 0.73. Notice the trend here. What are they doing to every regression beta by using this adjustment? 1.8 became 1.53. 1.5 became 1.33. 1.2 became 1.13. And zero point 0.6 became 0.73. They're pushing the beta towards 1. What's so magical about 1? It's the average beta for the market. They're trying to be helpful. They're saying over time, your company will probably get bigger. It'll probably look more like the market. The beta will start to move towards 1, to which your reaction should be, please stop helping. Because those 0.67 and 0.33 weights are the weights they use for every single one of the 40,000 companies they compute adjusted betas for. They're like magic weights. So the first time I encountered this, I was curious. Where do you come up with the 0.67 and the 0.33? So I called Bloomberg, not the mayor, but the company. And at that point, it was very confusing who you were calling. Maybe I should have called the mayor. Because I called the company, and they put me in touch with the beta calculation guy. There's actually a guy at Bloomberg whose life it is to maintain this page. Imagine how exciting his life must be. Okay. He's pathetically grateful to get a call from the outside world. You know what they do? Maybe they keep him locked up in a basement room, feed him through a hole in the wall. No. He said, I'm so glad you called. I have all day to answer your questions. Like 5 minutes to ask him questions. But I was afraid if I hung up the phone too soon, he might do something rash. So after about 10 minutes of polite conversation where I complimented him all things Bloomberg, I finally asked him the question, why 0.67 and 0.33? He said, huh? 2 minutes of silence. I can hear papers being rustled, terminals being turned off and on. And finally comes back on and says, I don't know, it was here when I got here. I said, when did you get here? He said, 3 years ago. Don't blame me. I said, I'm not blaming you. I just want to know where these numbers come from. He says, I don't know. Here when I got here. You know how often that is the response you get to numbers you use every day at work? He says, but why do we use the 6% risk premium? I don't know. It was here when I got here. When did you get here? 1979. You've never stopped and asked? No, I don't pick up rocks to see what's under them. So much of finance we've outsourced. Here when I got here becomes a response. And for God's sakes, that should never be the response to a number. So give me a reason, I'm willing to talk about it. But here when I got here doesn't do it for me. But the bigger story here is there's no information in the there's no adjustment in the adjusted beta. All it is telling you which direction one is. And if you're confused about that, maybe this is not the page you should be spending time on. You have a beta 1.5. We want to get to 1. You know how to get there, right? Go 1.4, 1.3, 1.2, 1. You don't need somebody holding and saying, let me give you a number closer to 1. That's all. And every single service plays this stupid game. They run a regression beta, and then they call it predicted beta, forecasted beta, adjusted beta, when all they're doing is moving the beta towards 1. So I did dig for the 0.67 and 0.33, and I found the original source. It's a paper written in 1971 in an academic journal, the Journal of Finance, where the researcher had looked at 100 companies through the 1960s and tracked the betas of every company through the decade. You're saying, why only 100 companies? In 1971, everything was done by hand. 100 companies was about all he could handle. And here's what he found. Those 100 companies through the 1960s, their betas moved towards 1 with a Stein estimate, which is a statistical way of saying the weighting factor is roughly 0.67 and 0.33. You're saying, how did that 1971 paper end up in the 2025 Bloomberg? The very first beta estimation service was started in Berkeley by Bar Rosenberg, who was a professor of finance at Berkeley and happened to be an editor of the journal that this paper came in. So Barra, when they started estimating betas, the way Bar Rosenberg decided how to get better betas was he went and looked at journal articles. And he remembered that one from 3 years ago. He said, that's a neat idea. So here's what I'm going to do. I'm going to run a regression beta, and then I'm going to move it towards one using these weights. That's 1974. And it stuck. Because every person after that, you know what the answer is? Where did they come from? I don't know. Here, when I got here. It's amazing number of things in finance get stuck once they get started. And nobody stops and asks, let's face it, that was 1971. The world has shifted and the weights should be different for different companies. So what I'd like you to do before Monday's class is pick a company. If you haven't picked it, no, that's first. Once you pick the company, find a Bloomberg, and I gave you the locations for a Bloomberg. And in fact, those if you follow my email on the 6 things you need from Bloomberg, it'll take you 10 minutes. You're done with the Bloombergs for the rest of the year. Do it while it's still, people are not lined up. Print the beta page for your company. And using that beta page, and when we start the class, we'll talk about what that tells you about the company and how you can use that beta page to come up with a hurdle rate for your company. Okay? So I'll see you on Monday.
Hey, Professor, I'm Patrick Barron.
Yes.
I just want to ask, like, for clarity on a comedy meet earlier. It was like the countries in the black box. You said where the people have given up. Like, what did you mean by that?
I'm sorry?
You said where the people have given up. I would ask you for clarity on that comment.
The black box, was it in
The
today's
country-
class?
Yeah, the countries, you said the countries, like, they don't have, like, financial data and all.
Well, I think part of the reason is when you have violence in a country and there's nobody running the country, so it's in South Sudan or Syria, you can't even start the process of assessing country risk because you have no idea who'll be running the country. So think about more recently, think about right after Assad fell in Syria, right? So
Okay.
now you don't even have a head of the country. You have this new government coming in. You have no idea what's happening. You essentially give up. You say, look, and I have to wait for things to settle in. Same thing with Russia. Since 2022, there's been no rating for Russia because the ratings agencies say, we've got to wait. We don't know how this war will play out, what will happen to the sanctions. So when there's that much uncertainty, even the ratings agencies step back and say, I'm not going to try to assess a rating when I have nothing to go on. The official records are all broken. I can't get to the data. So then there's no rating for the country. And people who are still invested in the country can't easily assess country risk because there's no guidance that they get out. Much of Africa used to be, if you looked at that map, now we have equity risk premiums for Africa. There was a point in time when there were only 4 or 5 countries, Nigeria, South Africa, Egypt, where you could get ratings. And the rest of Africa, the ratings agencies didn't even try because they said, no, it's not enough information. No. So I think that ratings agencies basically base their sovereign ratings on data like how much debt do you have now, what does your budget look like, and if there's no functioning government, which is often the case in those frontier markets, they don't even try.
Yeah, I thought it sounded a bit harsh when I first heard it, but I wanted to ask you for clarification and didn't want to make
Black
any
box is
assumptions.
just a period of place of uncertainty. It doesn't mean they're, so when you have that much uncertainty, there's.
Yeah. Thank you. Thank you for clarification. I appreciate it.
Take care. Hi, how are you? Good.
I just have a question about the group project.
Yeah.
Because we're finalizing the companies and our theme would be hospitality.
Okay.
And I was interested in doing Nestle in like the thought that it could be a supplier to hospitality.
That's stretching it
But
a little
is
bit
it-
right
okay.
now.
Okay, I just wanted to check.
So if you want to
Oh,
make it
doing something-
hospitality, pick something that is more direct. Pick a small company that feeds your hospital. Nestle is such a big
Yeah,
consumer
there's
product
just
company.
Swiss
Yeah.
company being Swiss,
No.
but
There might be Swiss companies that feed into this space. So,
well, it's off good considering they have a museum and stores, or also too far fetched.
if you really want to do a Swiss company, you're either going to end up with banks or those companies, right? You don't have much of a choice. unless you want to, don't think you can make On into because you want a
Yeah.
fun Swiss company, pick On, right? Shoe company, kind of breaking the
Yeah.
mold, kind of breaking in. But I think hospitality kind of constrains you, right? So what do you have? Hotel
Yeah,
companies,
I
you
think
got,
we have Airbnb, Expedia, TripAdvisor, an airline, a casino.
okay,
But okay, no, I mean, if it's too far-fetched, I'll go with like a more
yeah,
traditional.
something in the, there might be companies that feed into the hotel business that are kind of suppliers to the hotel business. So check to see whether they'll probably be smaller companies.
Yeah.
So Nestle chocolates might show up on a hotel pillow, but it's such a small percentage of their actual revenues that is not what's
Yeah.
driving them, right? So I'll check. I mean, maybe there's something. Does it have to be Swiss, or can it be can it be a small company that can be another European company?
I mean, it can be anything.
You know what?
just
One of the things you
considering.
can do is, I gave you the access thing for Capital
Mhm.
IQ, is you go to Capital IQ, you pick hospitality as a sector, and it's one of the sectors, see what shows up, pick a region of the world, Europe, and say, show me the companies, and then look through the list to see if you see a name that you recognize, right?
Yeah, okay.
And say, okay, I'm going to use that as my, I know there are publicly traded companies, for instance, that supply the airlines with food.
Yeah.
They're small. I know a couple of Asian companies that do it. I know that they're publicly traded, but I'm sure there are businesses that feed off the hospitality space.
Yeah.
No Travelocity. You don't, bringing Expedia or Travelocity, as is Airbnb capturing that as well? Because there are companies that make money off reservations. No, Airbnb goes beyond that, right? It's an intermediary, but there are businesses that used to be just brokering services, right? So there might be companies that do that are service companies that are not hotels, they're not Airbnb, but they feed off the space.
Or I think the airport also has like something.
You could. Airports are very different businesses, but there are, because of infrastructure businesses, and there are a few that are publicly traded, but there are companies that build airports,
Yeah.
right? Which are infrastructure
Yeah.
companies. That's a specialty. So you can, there's,
Yeah, I'll check for like a more traditional hospitality company.
you don't have a REIT in the hospitality space, like Marriott, there's
We
a
have
hotel, but
yeah.
there's Marriott the REIT, which owns just the real estate in a hotel. So basically, you're then looking at how does a company that owns the real estate but doesn't make any money from a hotel, how do they, fund themselves? How do they pick projects, right? Because it's a very different business. You're no longer making any money from the hotel. You're making money from the locations on which the hotels are built. So
okay, I'll check it out because I think now we have like almost just US companies. So I was trying to
pick a luxury hotel company in Europe then, which we have Marriott as a hotel company, but pick the Ritz or something which is Europe-based luxury hotel.
Okay.
Because that'd be a very different kind of hospitality because you'll be catering to a niche market of very rich people.
But that would be within like the guidelines of.
Maybe there's a skiing company in Switzerland that makes its money off the hospitality space. Check to see if there, because what else do you do in Switzerland? Eat chocolate, ski, hike, fondue. Maybe there's a fondue company, right? We are the global leaders in fondue. I don't know.
But that's helpful. Thank you. I'll check it out.
I will be super quick.
Yeah.
Thank you.
Yeah.
I don't know how to from a complete.
I think my point is when you run a business, just like you run a business, you face all of the problems that a business everywhere else faces times 3, right? That you then deal with. And it makes it really difficult for a business.
If that's mentioned as like as a professional
I'm sorry. Yeah, I will go back with this.
Yeah, but then my father also has been listening on. I was like, yeah, he's dealing with all these problems every day.
I am absolutely in awe that you can actually run a business with that much macro uncertainty that you get in the way of that.
Yeah.
But I'll be careful.
Thank you.
You go up and around, you go up there.
Yeah, I just feel okay.
Quite nice to just kind of like go through.